Hello and welcome to day 4 of the Love Your Money Challenge. My name is Elizabeth Booker and I am your financial coach here to help you earn more, save more, and start building wealth. Today, we are going to be talking about investing. And many people have told me that they've heard that when it comes to building wealth, investing is one of the ways that you can actually accumulate wealth. And it's true. And there are many ways that you can invest. You can invest in property, but today we're going to be talking about investing in the stock market. So if you've got your workbook, pull it up and we'll get into it together. In essence, investing is a way of redirecting your present resources so that it can create a benefit for you in the future. So, with regards to the stock market, we're going to redirect some of our income because we've seen how much we can save. We've organized our finances, created some space, and now that we've created some space with our money, we're going to see how we can take that pool of savings and put it to work so that it can actually create more money for us in the future. Okay, let's get to the workbook together. So you want to scroll on to day 4, and the first page we'll see our action plan for today. So today we're going to understand the basics of investing, learn how to dispel some common investing myths, and actually create a plan to start investing, right? Okay, first, understanding the basics. There are a few terms that will make it easier to make good financial decisions when it comes to investing, right? So as we know, investing redirects our present resources so that we can benefit from it in the future. And therefore, we can earn profit on our money by putting it into vehicles such as stocks, bonds, funds, and other assets. But how do we pick these assets and what is unique about them? And there are 4 main things are quite unique about all investing assets. First, the concept of risk and reward. Investing involves a balance between risk, which means possibility of loss, and reward, potential for growth, potential for increase, right? So we want to be able to balance it. You want to invest in things that are risky enough for you, but not too risky that you can't actually sleep. And you also want to put things that you know are not going to that you know you're going to get a reward from. It has potential for growth, even though we don't actually know the future, right? So I want you to have that in mind. When you're investing, it's possible for things to increase, and it's also possible for things to drop. But having that clearly in your mind makes sure that you're able to reflect on your comfort level. Where exactly is your risk comfort level? Are you more conservative, or are you really to try in order to get higher returns? So that's something that you have to think about. Next thing that we want to consider is the term called diversification. So basically, diversification means spreading your investments across different types of assets in order to reduce your potential for risk. So you want to invest in multiple things. You want to invest in things such as a mixture of stocks, bonds, funds, and different types of stocks, different stocks from different countries, different regions, different industries. So instead of putting all your money into one stock, you can consider mixing it up a little bit. And this reduces your risk because if you just invested in stocks in the transportation industry and something should happen where no one can step outside and no one is driving, no one is flying, no one is using modes of transportation, which we've experienced before just a few years ago, then that industry will face some kind of financial upset, right? And it might affect the potential for your money to grow in that industry alone. But if it's mixed up, when transportation is down, maybe fashion is going up, maybe tech is going up, and then you can, you would have a more balanced portfolio where your money isn't just dropping, it's going up, it's coming down, and it's a bit more balanced. Third thing that we want to think about is time horizon, which is the amount of time you have for your money to be invested. So your investment goals should align with the amount of time you plan to invest. So like when I said we talked about diversification and we talked about, fluctuations in the market, if you do have long-term investments, they will ride out the fluctuations because after, the market always goes in cycles. At one point, things will drop, and then it will go back up, then it'll come back down, then it'll go back up. But if you are investing for the long term, then that's okay because you will eventually ride it out and you will end up with a profit, most likely. But if you have a short-term goal that you are investing for, say you want to do something in the next 1 year and you want to invest now in the hope that your money would have grown, or in the next few months, you want to invest now in the hope that your money would have grown to a certain amount so that you can pick it out. There's no way to time the market. So it's hard for you to know if what would happen in the economy that would cause the market to have a sudden boost or have a sudden like implosion. So you want to think about it. What are you investing for? And based on that, you can pick what type of vehicle you will use, whether you're going to put your money in bonds because it's a bit more stable, or in stocks. And we'll talk more about that shortly. The next thing that we want to think about is compound interest. When you are investing, we earn compound interest. And this is basically interest on your interest. It is earning interest on both your initial investment, the initial money you put in, and the interest that accumulates over time. So it's a really, really powerful growth tool for growth. And you really see its power when you're investing for a long time. So the earlier you start, the more you see the power of compound interest on the money that you put in. Okay, let's bust some myths before we head on to the next step. Investing is just for the rich. The idea that investing is just for the rich, and so I'm not that rich, I don't have that much money, I can't start investing, is a lie. Even small amounts can grow over time through the power of compounding, as I just explained. So it's for everyone. I want you to say that with me. It's for everyone. It's for me. Investing is for me, and it's for everyone. Investing is too risky. The idea that investing is too risky or too complicated is also another lie. And please don't tell yourself that. It is not too complicated and it's not too risky. Why? Because there are safer ways to invest and there are more riskier ways to invest depending on your risk tolerance. And with proper education and diversification, investing can be very, very manageable. The third myth that many people think is that they need a financial expert to invest, and really you don't. Basic knowledge is actually good enough to start, and as you start, you start to learn even more with every as time goes on. And there are many, many, many resources available for beginners. I should wait for the perfect time to start investing. Now, this is actually a big one. And you'll see that it might actually come up for you several times, because especially when you're watching the news and you hear things you hear that stocks are crashing, you think it's not the right time, or stocks are soaring, is it the right time? Well, with a long-term steady approach and pound cost averaging or dollar cost averaging based on where you are, it is more reliable. So there's no perfect time. Just decide how much you're going to invest each month and do it regardless of what is happening. Okay, some common ways to invest. And we'll talk about a few common ways that people invest. One, buying stocks, right? And this is buying a piece of a company. So stock is just a piece, a tiny, it's a slice of a big company. And you would make money via dividends, which is profit that is shared out to stockholders quarterly, or via capital gains, which is when you sell your stock for a higher price than what you originally bought it for. If you sell your stock at a lower price than what you bought it for, that's called a capital loss. So, buying stocks is higher risk because you're buying a piece of an individual company alone. So it's a bit higher risk, but that also means that if the company does very well, it's higher rewards. Other ways of investing include buying bonds. In essence, bonds are like loaning money to a corporation or the government for like a guaranteed return. So it's a bit more stable, very low risk. I don't know any country that has, well, except for one that has defaulted ever, except for one. And then there are many countries in the world. So it's very low risk, and you don't tend to get a guaranteed return. Next way of investing is through funds, mutual or index funds or EFTs, ETFs. Now, a fund is a pool of savings that from many individuals, many people, also known as investors, you and me, our money is pulled together and invested in a variety of assets, including stocks, bonds, many other assets, commodities, art, gold, crypto, things like that. So it's a pool of savings from many people, and it's invested into a group of assets that has been pre-picked either by a person, if it's a mutual fund, or by an algorithm to match, by an algorithm based on what it is trying to match. With another type of fund is pension funds. And this is when you are setting aside money, or your employer sets some money from your income aside for you to be invested in assets, bonds, stocks, other assets by pension managers, right? And then you can access this as an income from a certain age. So that's a pension fund. So when it comes to investing, it's pretty much, you can just follow these 6 steps. First, you can start small. If you're starting to invest for the very first time and you're a bit worried, you can just start small with whatever you can put aside. Next thing, you want to educate yourself. I think it's always important to understand what you are investing in, even to a very small level. You want to educate yourself. Third, you want to set clear goals. What am I investing for, and for how long? Next thing, you want to be thinking about diversification with time. When I first started investing, I invested in just stocks alone, but that was not the best. It was not the best strategy, because when the stocks started going down, I was experiencing colossal loss all at the same time. But when you're diversified, when one industry is going down, one is going up at the same time. So it's a better way to manage risk. The next thing you want to do is to breathe and be patient. Be patient. Don't expect, a get rich quick investment return. Be patient and review your investments regularly. You can look at it, not every day, but you can keep looking at it regularly and seeing that, this is how far I've gone. And each month, keep adding, be consistent. So for our devotional reflection, we're going to look at Luke 6, verse 38. It says, give and it will be given unto you. Good measure, pressed down, shaken together, running over, it will be poured onto your lap. But with the measure you use, it will be measured to you. So just as a farmer plants seed with expectation of a harvest, investing is a way to plant financial seeds that grow over time. So I want you to consider your investments as an extension of your faith, a practical way to steward the resources that God has entrusted to you and nurture them for future generations and for your future too. So for your reflection prompt today, I want you to just take a moment to reflect on how sowing seeds, whether in your garden or in your finances, leads to growth and renewal. How can this perspective empower you to begin investing with confidence? So next is our investment action plan. If we go to the next page, and today we're going to put together a small personal road map, right? Okay. First, and we're going to do that by answering some questions and being committed to taking action on those from the answers that we give. First, investment goal. What is your primary goal for investing? Let's pick one for now. Are you investing towards the future? Investing to, for your children's education? What is your primary goal? Secondly, what's your starting amount? How much are you going to put aside to start with? There's no right or wrong answer, but what can you put aside now to start investing? So what you want to do is look back at your spending plan sheet from day one, look at how much we put aside for savings, look at how much we were putting aside for the different types of savings, retirement, for children's future, education, different things, and see what amount you have to put there, and you can insert that same amount there if it still aligns with your goals. Third, we want to look at your time. What is your intended investment time frame? If it's a short-term investment, you're thinking 1 to 3 years, mid-term 3 to 10 years, long-term 10 years plus. So what is your investment time frame? And then fourth is, what is your learning plan? What resources will you use to learn more about investing? Are you going to read some books, take some courses, listen to podcasts? What are you going to do next? And then I want you to write out your next step. List 2 actionable steps that you will take in the next week to start and to begin your investment journey. And if you do need help with this, I'm assisting a small group of women in the next coming weeks to start actually investing. So if you do want practical one-on-one guidance with this, definitely do reach out to me. So your commitment statement for today is 1, write down 1 key insight or commitment that you're taking away from today's session. And I commit to sowing seeds of my financial future by taking informed, intentional steps towards investing. I trust that patience, education, and faith and my small beginnings will yield a beautiful habit. Sign it and date it. And if you have any more notes, you can put it on the next page. But as always, feel free to join our WhatsApp group so that you can, ask questions, share insights, and, keep taking action. Today was it's a very small part of everything that we are learning about our money, but just keep taking action and you'll be well on your way to building a secure financial future. See you tomorrow.